Determining forward margin. We had already defined forward margin as the difference between the spot rate and forward rate of currency, making the forward currency cheaper or costly as compared to the spot currency. The difference in the rate of interest prevailing at different financial center is a dominant factor determining forward margin. Factors that affect forward margin are demand and supply of currency. Speculation about spot rate and exchange control regulation, rate of interest, the difference in the rate of interest prevailing at the home center and the concerned foreign center determines the forward margin. If the rate of interest at the foreign center is higher than the prevailing at the home center, forward margin would be discount. Conversely, if the rate of interest at foreign center is lower than that at the home center, the forward margin would be at premium. This can be explained as follows. When the banks enter into a forward sale contract, well, the customer it arranges for delivery of the foreign currency on the due date by keeping the funds in deposit at the foreign center concerned. If the interest rate is higher at the foreign center concerned, the net gain to the bank is passed on the customer by offering the forward rates at a discount. If the interest rate is lowered at foreign center, the bank suffered a net loss and the loss is passed on to the customer by quoting the forward rate at the premium demand and supply. The demand for and supply of foreign currency to a very great extent determines the forward margin in the foreign exchange market. If the demand for foreign currency is more than its supply, for forward rate would at premium. On the other hand, if the supply exceeds the demands, then the forward rate would be at discount. Profit motivate. Investors who want to gain out of the interest rate may try to borrow from low interest center and invest in high interest center. For example, the investor may borrow at New York at 6% and invest in Mumbai at 12%. In order to secure his position, he may try to cover the transaction in the forward market, then he will sell spot dollar and buy forward dollar. When may such investors do this with the intention of booking profit in the market, then the supply of spot dollar increases and forces the price for upward. Thus, the difference between spot and forward rates widens. The force of demand and supply may take the premium on the forward even beyond the limit set by interest differential. Therefore, it is not just interest differential alone that determines the forward margin. Sometimes it may also be stated at the loss on account of this premium may exceed the gain on account of interest differential on the investment. In that case, there is no point in carrying out the plan of investment. Speculation about the spot rate. The spot rate form the base for determining forward rates, and therefore any speculation about spot rates would influence forward rates also. If the exchange dealer anticipate the spot rate to appreciate, the forward rate would be quoted at premium. If they expect the spot rate to depreciate, the forward rate would be quoted at a discount. Exchange regulation. Exchange control regulation informed by the governments of the nation also influence the forward margin, and this regulation may be put some condition on the forward dealings and may obstruct the influence of the other factor on the forward margin. Such restrictions may include keeping of balances of road borrowing overseas. Each intervention in the forward market by the central bank may also be done to influence the forward margin. Summary and conclusion. In this chapter, we had understood the meaning of foreign exchange rate, and foreign exchange market. We had also discussed the basics of foreign exchange transaction, direct and indirect quotation, spot forward exchange rate, and forward margin edge. The determination of cross rates given the exchange rate for currency has also been discussed. Finally, we had also analyzed that the factor that determine the forward margin. Model question. Number 1. How foreign exchange rate is determined? Number 2. What are the factors that determine the foreign exchange rate? Number 3. Explain the concept of direct and indirect quotation. Number 4. Define the concept spot and forward exchange rate. Number 5. Explain need for forward exchange rate and also explain forward premium and forward discount. Number 6. Discuss the factors that determine forward margin. Number 7. Calculate the forward buying and selling rates of euro in terms of rupees for 1 month, 2 months, and 3 months. Spot euro 1 equals RS 54.4050 to 54.4060. 1 month forward equals 250 to 300. 2 months forward 350 to 400. 3 months forward 425 to 475. Chapter 2 Merchant Rates and Interbank Transaction. The object of this chapter is to introduce the reader the main elements of merchant transaction and different types of merchant rates quoted by the foreign exchange dealer. While banks being the authorized dealer in the foreign exchange market, the discussion on this chapter are also devoted to analyze the various interbank transactions carried out by the banks on behalf of their customers. Introductions. Foreign exchange transaction in the foreign exchange market can be broadly divided into two. One, merchant transaction, and 2. Interbank transaction. While the dealing of the bank with its customer is known as merchant business or merchant transaction, and the rates quoted in such transaction are called merchant rates. The foreign exchange transaction between banks are known as interbank transaction, and the rates quoted in such transaction are known as interbank rates. When a merchant transaction takes place, the exporter, in order to convert his sale proceeds received in the form of foreign currency into domestic currency, approaches the banker of his country. Similarly, the importer approaches his banker in his country to convert the domestic currency into foreign currency. Such transactions also take place when a resident approaches his bank to convert foreign currency received by him to home currency and vice versa. In both the deals, the bank book as profit. This explains the existence of a distinct relationship between merchant rates and interbank rates. The prevailing interbank rate becomes the basis for merchant rates. The merchant business in which the contract with the customer to buy or sell foreign exchange is agreed to and execute on the same day is known as ready transaction or cash transaction. As in the case of interbank transaction, the value next day contract is deliverable on the next business day, and a spot contract is deliverable on the second succeeding business day following the date of the contract. Most of the transactions with customer are on ready basis. In practice, the term ready and spot are used synonymously to refer to transaction concluded and executed on the same day. Basis for merchant rates. When the bank buys foreign exchange for the customer, it sells the same in the interbank market at better rates and thus make a profit out of the deal in the interbank markets. The bank will accept the rates as dictated by the market. It can be therefore sell foreign exchange in the market at the market buying rate for the currency concerned. Thus, the interbank buying rates form the basis for quotation of buying rates by the bank to its customer. In the same manner, when the bank sells foreign exchange to the customer, it meets the commitment by purchasing the required foreign exchange from the interbank market. It can be acquire foreign exchange from the market at the market selling rate. Therefore, the interbank selling rates form the basis for quotation and selling rate to the customer by the bank. The interbank rate on the basis of which the bank quotes its merchant rate is known as base rate. Exchange margin. When a merchant customer approaches his banker for foreign exchange and if the bank quotes the base rate to customer, it makes no profit. On the other hand, there are administrative costs involved in the transaction. Moreover, the deal with the customer takes place first and only after acquiring or selling the foreign exchange from the customer. The bank goes to the interbank and market to sell or acquire the foreign exchange required to cover the deal with the customer. Between this transaction, there will be time gap of say an hour or two and the exchange rate are fluctuating constantly and by the time deal with the market is concluded, the exchange rate might be have turned adverse to the bank under such circumstances to cover the administrative cost to overcome the exchange fluctuation and the gain some profits on the transaction to the bank sufficient margin need to be built into the rate. This is done by loading exchange margin to the base rate. The quantum of the margin that is built into the rate is determined by the bank concerned keeping with the market trend. FDI has standardized the exchange margin to be charged by the bank and the banks are free to load margin within the range. The FDI fixed margin are 8 1. TD for case rate 0.025% to 0.080%. Number 2. Bills for case rate 0.125% to 0.150%. Number 3. TT selling rate 0.125% to 0.150%. Number 4. Bill selling rate 0.175% to 0.200% over TT selling rate. Fineness of quotation. The exchange rate is quoted up to 4 decimal in multiples of 0.0025. The quotation is for 1 unit of foreign currency except in the case of Japanese yen, Belgian franc, Italian lira, Indonesian rupiah, Kenyan shilling, Spanish peseta, and currencies of Asian clearing onion countries. Bangladesh, Taka, Myanmar, Kyat, Iranian Nial, Pakistani rupee, and Sri Lanka rupee, where the quotation is per 100 units of the foreign currency concerned. Example of valid quotation are USD 1 equals RS 43.2350, GBP 1 equals RS 63.3525, Euro 1 equals RS 43.5000, GPY 100 equals RS 35.6075. While computing the merchant rates, the calculation can be made up to 5 places of decimal and finally rounded off to the nearest multiple of 0.0025. For example, if rate of US dollar works out to RS 43.12,446 per dollar, it can be rounded off to RS 43.1250. The rupee amount paid to or received from a customer on account of exchange transaction should be rounded off to the nearest rupee, i.e. up to 49 paisa should be ignored and 50 to 99 paisa should be rounded off to the higher rupee. Rule 7 of FDI. Different modes of foreign exchange remittances. The flow of foreign exchange may take the form either moving into the country as a result of foreign for case transaction or moving out of the country as a result of a sale transaction. Either case, the remittances could take place through various forms. The different forms of remittance are 1. Demand draft, 2. Mail transfer, 3. Telegraphic transfer, and 4. Personal request. Type of buying rates. In a forecast transaction, the bank acquires foreign exchange from the customer and pays him in Indian rupees under such circumstances, while some of the forecast transaction result in a bank acquiring foreign exchange immediately. Some may take time in the acquisition of foreign exchange. Say for instance, if the bank's pay and demand drafts drawn on each by its corresponding bank, there is no delay because the foreign correspondent bank would already have credited the nostro account of the paying bank while issuing the demand draft. On the other hand, if the bank forecases an on-demand bill from the customer, it has first to be sent to the drawing place for collection. The bill will be sent the correspondent bank for collection. The correspondent bank will present the bill to the drawee. The nostro account of the bank with its correspondent bank is credited only when the drawee makes payments against the bill. Suppose this takes 20 days, the bank will acquire foreign exchange only after 20 days. Based on the realization of foreign exchange by the bank quotes two types of buying rates: TT buying rates and bill buying rates. Number 1. TT buying rates. TT stand for telegraphic transfer. When there is no delay involved in the realization of foreign exchange by the bank, then the rate Applicable in such transaction is TT buying rate. In other words, the bank account with the overseas bank account of the bank would already have been credited with. In order to arrive at the TT buying rate, the exchange margin is deducted from the interbank buying rate. Though the name implies telegraphic transfer, it is not necessary that the proceeds of the transaction are received by telegram. Any transaction where no delay is involved in the bank acquiring the foreign exchange will be done at TT rate. Transaction where TT rate is applied are payment of demand drafts, mail transfer, telegraphic transfer, each drawn as the bank where bank's notional account is already credited. Foreign bills collected. When a foreign bill is taken off collection, the bank pays the exporter only when the importer pays for the bills and the bank's notional account abroad is credited. Cancellation of foreign exchange sold earlier. For instances, the for cases of the bank draft drawn on New York may later request the bank to cancel the draft and refund the money to him. In such case, the bank will apply and the TT buying rate to determine the rupee amount payable to the customer. The method of calculating TT buying rate for foreign exchange to be forecast for US dollar is given below. TT buying rate dollar rupee market spot buying rates RS less exchange margin RS TT buying rate equals RS rounded off the nearest multiple of 0.0025. 2. Bill buying rates. When foreign bill is forecast, then the rate applicable would be bill buying rate. Under this, when a bill is forecast, the proceeds will be realized by the bank after the bill is presented to the drawee at the overseas. In the case of the Yuan bill, the proceeds will be realized on the due date of the bill, which includes the transit period and the Yuan period of the bill. As suppose that a site bill on London is forecast, the realization will be after period of about 20 days transit period, and the bank would be able to dispose of the foreign exchange only after this period. Therefore, the rate quoted to the customer would be based not on the spot rate in the interbank market, but on the interbank rate for 20 days forward. Similarly, if the bill forecast is 30 days Yuan bill, then the bill will realize after about 50 days, 20 days transit plus 30 days Yuan bill period. Therefore, the bank would be able to dispose of foreign exchange only after 50 days. The rate to the customer would be based on the interbank rates for 50 days forward. It is important that while loading the bill's buying rate with forward margin, 2 points need to be taken into account. First, forward margin is normally available for periods of a calendar month and not for 20 days each. Second, currently forward margin may be at a premium or discount. Premium is to be added to the spot rate, and the discount should be deducted from it since the bank aim is to book profit. While making calculation, the bank will see that the period of which forward margin is loaded is beneficial to the bank. Let us suppose that on 23rd January, interbank of quotation for US dollar was as under spot USD 1 equals RS 43.5,000 to 5,500. Spot January 2,000 to 2,100. Spot February 5,000 to 5,100, March 7,500 to 7,600. The bank wants to calculate bill buying rate for a site bill. The transit period is say on 20 days. The bill fall due on 12 February. Apparently, the forward rate relevant is spot February rate as this valid for the entire month of February. However, it should be noted that the forward dollar is premium. The customer will be getting more rupees per dollar under the forward rates than under the spot rate, as we had already seen. The forward premium represents the interest differential. The spot February forward premium includes interest differential up to the last day of February, as the benefits does not fully accrue on 12 February. When the bills expected to mature, the bank will not concede premium up to this month. It will concede premium only up to the last complete month and base its bill buying rate for dollar on the spot January forward rate. If the bank takes spot February forward premium, the base rate will be Rs 0.44.0000. By taking only spot January premium, the bank offers only Rs 43,700 per dollar, which is beneficial to the bank. In case of the 30 days usual bill submitted on the same date, expected due date cancel the national due date. It's 14 March. The bank will concede premium only up to February. Thus, where is the foreign currency's premium while calculating the bill buying rate? The bank will round off the transit and usual period to lower month. Let us assume that the on 18th April dollar is at discount and the quotation in the interbank market is as under spot USD 1 calls are as 42.7500 to 8,000. Spot April 1,300, 1,200. May 3,000 to 2,900. June 5,500 to 5,400. Let us consider an example that the bank is required to quote a rate for forecasting a site bill on New York. Transit period is 20 days. The bill will fall due on 8th May. Since dollar is at discount, forward dollar fetches lesser rupees than spot dollars. In other words, longer forward period involved the bank is able to get dollar from customer at cheaper rate. Therefore, the bank will deduct discount up to May and while quoting for this bill in case of a usual bills for 30 days, the due details falls on 7th June. The bank will base its rate to the customer on spot June forward rate. Here the due date of the bills is rounded off to the higher month, i.e. end of the month in which it falls. Thus, where the foreign currency is at discount, while calculating the bill buying rate, the bank will round off the transit and usual period to higher month. It is important to keep in mind the rule of loading forward margin in the bill buying rates for calculating bill buying rates. If the forward margin is on premium round of the transit period and usual period to lower month, if the forward margin is at discount round of the forward margin to the higher month. In the TD buying rate, the bank would include exchange margin in the rate quote to the customer while quoting for case of bills also. The margin may be slightly higher than that for TT buying rate. It should have been observed that there will be more than one bill rate each for a different period of usual of the bill. The method of calculating bill buying rates is as followed. Bill buying rate dollar rupee market spot buying rate equals RS. Add forward premium for transit and usual rounded off to the lower month, or less forward discount for transit and usual rounded off to the higher month RS equals RS less exchange margin RS. Bill buying rate RS rounded off to the nearest multiple of 0.0025. Recovery of interest on bill for case when the bank buys a bill from customer, it immediately pay him in Indian rupees. The bank is entitled to claim interest from the customer from date of purchase of the bill till the bill realized and credit to the nostro account of the bank with correspondent bank abroad. On the rupee value of bill purchase on the date of purchase itself, the bank should collect separately by debit to customer account the interest on the bill up to its anticipate due date cancel the national due date, comprising the normal transit period, the usual of the bill, and the grace period if applicable at the place where the bill is drawn payable. The normal transit period of transit allowed by FEDI for bills drawn on different countries. The rate of interest to be collected will be determined by the bank concerned subject to the directives of Reserve Bank in this regard. Interest shall also be rounded off to the nearest rupee. Interest is calculated by the formula. Rate value of bills x rate of interest x number of days 100 times 365 for the bill in example. Assuming an interest rate of 10% PA, the interest recovered on for case of the bill would be as followed. 4,298. 750 times 10 times 20 equals RS 23,555. 100 times 365 types of selling rates in a sale transaction when the bank sells foreign exchange and it actually receives Indian rupee from the customer and the part with foreign currency. The sale is affected by issuing a payment instrument on a correspondent bank with which it maintains the nostro account. Immediately on sale, the bank buys the requisite foreign currency, yes, from the market and gets its nostro account credit with the amount so that when the payments instrument issued by it's presented to the correspondent bank, it can be honored by the debit to the nostro account. Therefore, for all sales on ready spot basis to the customer, the bank resorts to the interbank market immediately and the base rate is the interbank spot selling rate. However, depending upon whether the sale involves handling of the documents by the bank or not, two types of selling rate are quoted. In India, there are TT selling rate and bill selling rate. Number 1. TT selling rate. This is the rate applicable for all transactions which do not involve handling of documents by the bank. Transactions for which this rate is quoted are issue of demand drafts, mail transfer, telegraphic transfer, each. Other than for retire of an import bill and payment made for an import transaction, where documents were received directly by the importer. Cancellation of a forecast transaction, the TT selling rate to the customer is calculated on the basis of interbank selling rate by adding exchange margin to the interbank rate. Number 2. Bill selling rate. This rate is used for all transactions which involve handling of documents by the bank, for example, payments against import bills. This bill selling rate is calculated by adding exchange margin to the TT selling rate. That means the exchange margin enters into the bill selling rate twice, once on the interbank rate and again on the TT selling rate. The method of calculating selling rate is given below: selling rates, TT and bill selling. Dollar, rupee, market spot selling rate. RS add exchange margin for TT selling rate plus RS TT buying rate equals RS add exchange margin for bill selling rate plus RS bill selling rate. RS round off to the nearest multiple of 0.0025 and quote to customer some aspect of exchange quotation. Spread between TD rates while making exchange quotations. The bank have discretion to include the exchange margin at rates determined by them. However, the maximum spread between TT buying and TT selling rates quoted to the customers shall be as follows. Name of currency, current maximum spread between customer rates for TT buying and TT selling from the mean TT rate talking both sides together. US dollar 1%, pound sterling, dioche, marks, Japanese yen, French franc, Swiss franc, Dutch guilder, and Australian dollar. Other currencies 2%, no limit at present, but banks shall keep the rate spread to the minimum. The bank are, however, free to quote customer which are better than those warranted by the spread limits. Let us call the currency other than US dollar, for which the exchange rate is calculation of ready rates as the foreign currency. Suppose a customer tenders a foreign current bill for forecast by the bank. We had seen in the last chapter that when customer tendered a dollar bill, the bank disposes of the dollar acquired from customer in the interbank market at the market buying rate, and therefore interbank buying rate for dollar forms the basis for quoting dollar buying rates the customer. In the case of foreign currency being tendered by the customer, bank should first get the foreign currency converted to US dollar in the international market. In other words, it has to buy dollars into the international market against foreign currency. The bank can be so at the market selling rate for dollar. Therefore, the merchant rate for the foreign currency will be calculated by crossing the dollar selling rates against the foreign currency in the international market and the dollar buying rate against rupee in the interbank market. The method of calculating ready rates does its tabulate below. Rates. When the bank sells foreign exchange other than dollar to the customer, it has acquired the required foreign currency in the international market by selling equivalent US dollar. The bank can sell US dollar in the international market. The market buying rates for us dollars against to the foreign currency concerned dollars required to affect the sales have to be acquired in the interbank the market selling rate. Therefore, in the calculating the merchant selling rate foreign currency, the relevant rates are dollar buying rates against to the foreign currency concerned in the international market and dollar selling rates against rupees interbank market. Forward exchange contract. In the previous chapter, we had already discussed the forward exchange rate and the context in which it arises each. Here our interest is to understand how the forward exchange rate is entered and the problems associated with it. A forward exchange contract is a mechanism by which one can ensure the value of one currency against another by fixing the rate of exchange in advance for transaction expected to take place at a future date. It is a tool to protect exporters and importers against exchange risk. The uncertainty about the rate which would prevail on a future date is known as exchange risk. From the point of the exporter, the exchange risk is that the foreign currency in which the transaction takes place may depreciate in future and thus the expected realization will be less in terms of local currency. The importer also faces exchange risks when the transaction is designated in a foreign currency. In this case, the foreign currency may appreciate and the importer may be compelled to pay an amount more than that was originally agreed upon in terms of domestic currency. In the case of forward exchange contract, two parties, one being a banker from one country entering to a contract to buy or sell a fixed amount of foreign currency on a specified future date or future period at a predetermined rate. Forward exchange contracts are entered into between a banker and customer or between two parties. Future or forward exchange contract. The following are the future of a forward exchange contract. FIDI has also laid down certain guidelines defining certain aspects of forward exchange contract. A. Parties. There are two parties in a forward exchange contract. They can be 1. A bank and customer, 2. Two banks in the same country, 3. Two banks in different countries. B. Amount forward exchange contract are entered into a definite sum expressed in foreign currency. C. The rate at which the conversion of foreign exchange is to take place at a future date is agreed upon the time of signing the forward contract, which is known as the contract rate and it's to be mentioned in the contract. D. Date of delivery. Date of delivery in a forward contract means the future date on which the delivery of foreign exchange is to take place and compute from the spot date or date of contract. However, in practice, date of delivery is computed from the spot date and hence if a forward contract is signed in 30th October with spot date as November 2005 for two months forward. The date of delivery is January 1, 2006. In India Rule 7, FIDI has laid down certain guidelines regarding date of delivery under forward contract. In the case of bill, documents negotiate forecast or discounted date of negotiation, forecast or discount and payment of rupees to customer. In the case of bills, documents sent for collection, date of payments are rupees to the customer and the realization of bills. In case of retirement, crystallization of the imports bills document date or retirement, crystallization of liability, whichever is earlier. E. Option period. In age of FIDI, under Rule 7 has laid down guidelines. Option period of delivery on an option forward contract should be specified as a calendar week, that is 1st to 7th, 8th to 50th, 16th to 23rd or 24th to last working day of the month, or a calendar fortnight, that is 50th or 16th to last working day the month. If the fixed date of delivery or the last date in option forward contract happen to be holiday, the delivery shall be affected delivery option exercised on the preceding working day. F. Option of delivery in all option forward contract, the merchant, whether a buyer or a seller, will have the option of delivery. G. Place of delivery. All contracts shall be understood to read to be delivered or paid for at the bank, and the name place, that is the contractual obligation under a forward exchange contract like delivery or foreign exchange or payment, are to be executed at the specified branch of the bank. Guidelines for forward contract. Rule number 7. Exchange contract shall be for definite amount unless date or of delivery is fixed and indicate in the contract. The option period of delivery should be specified as calendar week or calendar fortnight or calendar month. If the fixed date of delivery or last date of delivery option is a holiday, the delivery has to be affected on the preceding working day. Place of delivery is always at the bank and at the name place. Option of delivery is always that of the merchant. The minimum commission is Rs 250 for booking a forward contract. Minimum charge is Rs 100 for every request of early delivery extension, cancellation, fixed and option forward contract. Under the fixed forward contract, delivery of foreign exchange should take place on a specified future date. Then it is known as fixed forward contract. Suppose a customer enter into 3 months forward contract on 5th January with his bank to sell euro 15,000. Then the customer would be presenting a bill or any other instrument on 7th April to the bank for euro 15,000. The delivery of foreign exchange cannot take place prior to or later than the determined date, though forward exchange is a mechanism wherein the customer tries to overcome that exchange risk. The purpose will be defeated if the delivery of foreign exchange does not take place exactly on the due date. Practically speaking, it is not possible for any exporter to determine in advance the precise date on which he will be tendering export documents for reasons which are internal relating to production. Besides internal factors relating to production, many other external factors also decide the date on which he is able to complete shipment and present documents to the bank. More often, what is possible for the exporter is only estimate the probable date around which he would be able to complete his commitment. Under such circumstances, just to avoid the difficulty of fixing the exact date for delivery of foreign exchange, the customer may be given a choice of delivering the foreign exchange during a given period of days. Such an arrangement whereby the customer can sell or buy from the bank foreign exchange on any day during a given period of time. At a predetermined rate of exchange is known as option forward contract. The rate at which the deal takes place is the option forward rate. For example, on 10th June, as customer enter in a 2 months forward sale contract while the bank with option over August. It means the customer can sell foreign exchange to the bank on any day between 1st August and 31st August. In the example, the period during which the transaction takes place is known as the option period. Computation of forward exchange rate. Fixed forward contract. The method of calculation of forward rates is similar to that of ready rates discussed earlier. However, the case of forward rates, the forward margin added will include the forward period as well besides the transit usual period, while selling the forward margin is included only for the forward period.